The year is 1711. Sir Isaac Newton, arguably one of the most brilliant minds in human history, the man who literally mapped the laws of gravity and invented calculus, was about to make the most financially devastating mistake of his life. He took his entire life savings and poured it into the stock of a newly formed British enterprise called the South Sea Company. When Newton entered the market, the stock was moving in a near vertical line. It was a speculative frenzy. Everyone around him, from aristocrats to his own neighbors, was getting rich overnight. Initially, Newton was cautious. He actually bought in early, made a handsome profit, and got out. But as he watched his friends, people he considered far less intelligent than himself, continue to hoard massive wealth as the stock kept climbing, his discipline shattered. He couldn't stomach the envy. He went back in, investing every single penny he owned at the absolute peak. A few weeks later, the market collapsed. Newton was financially ruined. In the aftermath of the crash, he famously remarked, "I can calculate the motion of heavenly bodies, but not the madness of people." Today, over 3 centuries later, our technology is unrecognizable. We trade on high-speed smartphones, and Wall Street is governed by quantum algorithms. Yet the human madness Newton succumbed to hasn't changed by a single fraction. In economics, this psychological trap is known as the greater fool theory. It is an invisible, lethal mechanism where the prey isn't the uneducated or the gullible. In this game, your own intelligence and arrogance are your greatest liabilities.
Let's break down the mechanics of the trap without the academic jargon.
Imagine walking down the street and seeing a vendor selling a plain, mass-produced clay brick for $10,000. You know with absolute logical certainty that the brick is worth no more than $5. Rationally, you walk away. But then the vendor stops you and says, "Buy it for $10,000 anyway, because exactly 30 minutes from now, another guy is going to walk down this exact street and he will gladly buy it from you for $15,000. Suddenly, your logic battles your greed. The asset is worthless, yes, but if you can pocket a clean $5,000 profit in 30 minutes, does the intrinsic value of the brick actually matter to you? You buy it. Not because you value the brick, but because you operate on the absolute belief that there is a greater fool out there willing to pay a higher price. The greater fool theory doesn't rely on cash flows, earnings, or utility. It relies entirely on a chain reaction of perception. Someone else will be dumber than me. As long as new buyers enter the market, fueled by the same belief, the bubble expands. The early fools get rich, praised as visionaries. But the math of a finite world eventually catches up. The music stops the exact moment the absolute greatest fool buys the asset at the absolute maximum price. When there is no one left to sell to, the illusion evaporates, and the asset aggressively reprices back to its true value, zero. History doesn't change because human software doesn't get updated.
During the dot-com bubble of the late 90s, companies added .com to their names, and their valuations multiplied by 10 overnight. They had no revenue, no viable product, and no business model. Investors knew it was absurd, but they bought anyway, confident they could pass the hot potato to the next guy before the timer ran out.
Look at the digital asset boom of 2021. People spent millions on basic digital images that anyone could right-click and save to their desktop. Did they buy them out of a deep, profound love for digital art? Of course not. They were playing the psychology of the room. They bet that the line would keep going up forever because the internet had an infinite supply of buyers. they forgot that liquidity can dry up in a matter of seconds. So, why do brilliant people consistently fall for this? It comes down to two deep-seated evolutionary flaws: FOMO and herd mentality. When you watch a colleague at work or an acquaintance on social media make a fortune off a random meme coin or an obscure penny stock, your analytical brain shuts down. The pain center of your brain lights up. You think, I work 80 hours a week, I have a degree, and this person just made my annual salary in a weekend by doing nothing? Am I the idiot here? That social pressure forces highly rational individuals to throw their risk management models into the trash and run straight into the herd. We like to think that Wall Street institutions and hedge funds are immune to this emotional baggage. But the truth is far more cynical. They are the ones who build the stadium. They manufacture the hype, drive the initial momentum, and wait for the retail public to rush in at the very peak. Once the retail money provides the exit liquidity, the smart money quietly dumps their shares and exits the building. There is an old, brutal axiom in poker and trading. If you've been at the table for 30 minutes and you don't know who the sucker is, you're the sucker. In our modern, hyper-connected economy, where a single viral post can coordinate billions of dollars of capital in minutes, the greater fool trap is more sophisticated and dangerous than ever before. The second you allocate capital into an asset solely because the price is going up and it's the next big thing, you aren't investing. You are just standing in Sir Isaac Newton's line, hoping the collapse happens to someone else. The market will always give you opportunities to profit, but it will also strip you of your arrogance the moment you mistake a speculative bubble for financial genius. So, the next time an asset class defies all laws of fundamental economics, look closely at the charts and ask yourself one final uncomfortable question. Are you genuinely riding a wave of innovation? Or are you just a small fool waiting around for a bigger one?